If you follow Warren Buffett, then you know that an interview with Becky from CNBC is always on the cards, and this year is no different. He recently sat down with her to discuss some of the things we've been seeing happening in our economy. So let's look at what he had to say and what lessons we can pick out of that interview. Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. I'll start off with what many might agree is the elephant in the room, the banking crisis and how it was handled. This is what he had to say.
Well, I would say that some of the dumb things that banks do periodically, have become uncovered during this period, and as one of the banker told me one time, he says, "I don't know why we keep looking for new ways to lose money when the old ones are working so well." And they made the same mistake, some banks in this period, by they haven't made as many mistakes. They expect to make some mistakes in making loans, but they haven't, and particularly if you're getting into credit card loans, I mean, that's just part of the game. But they haven't made the same sort of mistakes that they made back in 2008 or 9. But they have mismatched assets and liabilities, and bankers have been tempted to do that forever, and every now and then it bites them in a big way. Accounting procedures have driven some bankers to do some things that may have helped their current earnings a little bit and caused the recurring temptation to get a little bit bigger spread and report a little more in earnings, and it ended in a result you could predict. You couldn't predict when it would happen, and then once they start looking at one that does it, then they start looking at others, and pretty soon, that everybody is in a position of looking at a number that nobody looked at when it was it was presented to them a year ago, if you read the 10K or anything of the sort. But the banks did not call attention to what they were doing when it was going on, and I would read investor contact when they would have meetings with financial analysts or the people who follow banking, and nobody even brought up the point virtually. And believe me, if we've got a $50 billion loss or something at Berkshire, we would expect people to know about it. And it's happened before. It's happened this time. It'll happen again someday.
So Warren essentially is saying that the cause of the recent bank failures is pretty much the same as in times past. They made a number of similar mistakes, like mismatching assets and liabilities and not reporting losses as they should, which gave a false sense of security to investors because as far as they could see, things were fine. This is something we saw happen recently with the banks that fell. But this raises a question. How do we know when such is the case so we can do something about it?
Did you see this? You were reading through the reports. You followed all these banking earnings that were coming in. So you noticed it. You saw it?
Sure, I noticed it.
Is that why you sold so many of the banking stocks you owned?
We sold a number of banks. I mean, we had held some of them for 25 years, but I don't like it when people get too focused on the earnings number and forget what my view is basic banking principles. I'm not going to get into naming any names or anything like that, but it happened to varying degrees throughout the industry. And the politicians say, well, the big banks did this, and that isn't true. I mean, I know who has been holding long-term instruments, and if let's take commercial mortgages or something of the sort, they carry them at cost, basically, and they can't sell them at that cost. And it's important that banks retain the confidence of the public, and they can lose it, in seconds. And we saw a country that was not worried about banks, until about Wednesday or Thursday of the week when Silicon Valley fell apart. And then all of a sudden everybody was worried about it all over the country. And the interesting thing, of course, is that it will not cost the government a penny. I mean, people think that, that somehow the government's going to get hung up with us. The FDIC is in effect, a very peculiar mutual insurance operation that is run by the government but is financed by the banks. And FDIC had 120 billion or so at the start of the year, and that's all money that banks have paid in, less what the FDIC has had to pay out on losses. If the FDIC has to pay out 250 billion this time or 300 billion, they just assess the banks more. And they don't do it in a very business-like manner because the public has the impression that the FDIC is the United States government and that so on. And of course, they do appoint the people, but the costs of the FDIC, including the cost of their employees and everything else, is borne by the banks. So banks have never cost the federal government a dime. But that the public doesn't really understand the whole FDIC thing, and the comments of public officials confuse it and the issue enormously. People shouldn't be worried about losing their money and the deposits they have in an American bank. And today they have no reason to worry. But the message has gotten very confused, and people don't really understand how it all works. And politicians can make hay out of it, and all kinds of things. Bad things happen when people don't understand some major institution and who actually bears the costs and what the responsibilities are. And nobody is going to lose money on a deposit in the U.S. bank. I don't know about the rest of the world. I don't know. I'm not that familiar with it, but it's not going to happen. And that message has gotten mixed up.
He analyzes reports and earnings. That way, he was able to see how his money could be at risk and therefore decided to sell. He talks of how he saw certain practices that he did not agree with, and that was a big determining factor in him selling some of his bank stocks. A business moving away from its core principles can be a big reason to sell. An important point that Warren highlighted was how the banks are trusted by customers. But when people heard of what was happening with Silicon Valley Bank, they couldn't help but worry about their money that was in the bank. So they decided to withdraw their money, which is a big reason why the bank fell. He then talks about the FDIC insurance and how it works. Many other countries have some kind of deposit insurance that will cover depositors up to a certain amount. This is good news for the depositors. But what about the investors? Well, as an investor, you've pretty much lost out if you didn't sell. That's some of the risks that one has to be aware of when investing. Every industry has its own risks, so this just goes to show that as much as investing can be profitable, if it is not done right, it can cause a lot of losses, which can lead to heartache and pain. As a depositor, it is important to understand how the depositor's insurance in your country works, so you know what to do in order to be on the safe side. I think it's important that we understand why the banks that fell did. Silvergate Bank and Signature Bank both fell due to significant exposure to the cryptocurrency market. Silicon Valley Bank failed when a bank run was triggered after it sold its treasury bond portfolio at a large loss, causing depositor concerns about the bank's liquidity.
Are we through the banking crisis at this point?
We're not through with bank failures, but we are through the depositor. The depositors haven't had a crisis. The owners of banks may have lost a hell of a lot of money. The people who bought the debt of the holding company, they may lose a lot of money. People can lose a lot of money, but the depositors aren't. And so you don't need to turn a dumb decision by managers into a panicking the whole citizenry of the United States about something they don't need to be panicked about. I mean, it is really. I just don't know why you do it with people. We set up the FDIC to relieve the worry of people. And initially, it wasn't the same institution it is now.
But you're saying on one hand, okay, no depositor is going to lose money. On the other hand, you're saying we're not through the bank failures.
Banks can go bust. But depositors aren't going to be hurt. I mean, banks can go bust. I mean, the Continental Illinois Bank was thought to be impregnable, back many years ago. And, the Franklin National Bank, the Bank of the Commonwealth. And sometimes they go broke because they make too many dumb loans, and sometimes it's because they mismatch maturities.
Warren here is speaking about the decision that was made when the United States Federal Reserve, the FDIC, and the US Treasury came together to bail out all the depositors. This in large part to prevent fear from spreading countrywide and people causing even more bank runs. He says that the general public should not have to suffer for the decisions that were made by managers. That's what things like the FDIC exist for.
What do you think of the job the Fed is doing right now?
I do not think I could run the Fed as well as Jay Powell's run. I think Jay Powell has been a terrific, and part of the job. Well, look at Paul Volcker back in the 1980s. I mean, people were sending him. I mean, he needed Secret Service protection and everything else. But in the end, he felt his responsibility was to do the right thing at the Fed, and he didn't give a damn about what anybody wrote about him or anything else. And I think that he's one of my heroes, and I think he's one of Jay Powell's heroes. And I think Jay Powell did the same thing actually in March of 2020 when we went into the pandemic. I think at the annual meeting that year, I said, that he was a hero and he is a hero, and you have to act, and you have to act on insufficient information, and you've got an ultimate responsibility to the American public. And it doesn't mean you can stop recessions. It doesn't mean that you can turn bad loans into good loans or anything else. But it does mean that you got to keep the system working. And the system came close to stopping.
This is a very interesting take from Warren. A lot of people criticize the Fed, especially Jerome Powell in particular, for the way rates were raised and the effects thereof. Warren actually praises him and makes reference to Paul Volcker, whom he calls his hero. In the 1970s, Volcker was the Fed chair. He made the difficult decision to raise the interest rates to 20%, which helped decrease the inflation, which had gotten as high as 14.8%. This did not go down easily though. It caused a major recession, job losses, and protests, but in the end, it got the job done. He's pretty much saying that there's no easy way out, and that tough decisions have to be made. All this he praises Jerome Powell for understanding and implementing. Let's now look at Warren Buffett's philosophy when it comes to investing.
And I can't tell you what the Fed was doing when I was buying Berkshire day by day or week by week or month by month or year by year. We were buying Berkshire, and and we've kept buying things, and we don't make stock market guesses, and we don't know how to profit by looking at broad statistics and guessing what stock markets or bond markets will do.
But you have said that you do pay attention to interest rates, and that interest rates are like gravity on equity prices.
There's no question about that. I mean,
so where's the level of gravity? Are we on the moon? Are we on Earth?
Well, we're in a way different position than we were when essentially what the option was to get 4 basis points on bonds, and that changes the value. It changes the value of real estate, changes the value of equities. It changes everything. But that's all happened in my lifetime, various ways, all the way up to a 21.5% prime and down to 0, which nobody thought we would ever get to. Anything can happen, and we're prepared for anything, but we like to do things. Over time, we want to buy good businesses. It's that simple, and we always want to have money.
The goal is to continue to buy good businesses. That's what Warren is all about. Whether inflation is high or not, he doesn't focus on the short term. The economic market might go up and down, but this does not concern him much, since in the long term, those movements fade into insignificance. Broad statistics don't mean much to him. Only interest rates do. This is due to the fact that they actually affect the returns on things like bonds and treasuries, where he stores a good amount of money so that he can gain a bit of profit while he waits for it to be deployed into new investment opportunities.
I know what a lot of different businesses are doing, and I just got a report from one of them that happens to be in the retail-related business. And in any event, it was minus 22% in February from a year ago. They didn't think that was going to happen.
Sales? You mean
in sales.
profit? Yeah,
in sales. Profits are down a lot more than that. On the other hand, some of our businesses are still doing fine, but they all are reporting that the new, some of them are living off of orders were placed months earlier and that sort of thing. But it's a tougher world out there in a great many businesses. 58 years I've been running Berkshire. I mean, we've run into all kinds of problems, but that's what business is about. And we run our business so that we don't depend on everything being big hunky-dory always. We run it so that we will be the last man standing. And that's the way, if millions of people are going to give me their money and tell me to take care of it.
Warren here speaks of how success can be achieved in any kind of economic situation. With talks of a recession looming, he says that it's a tougher world for businesses, but things are way better than many expected. The economy sometimes doesn't look so good, but if we position ourselves right, we can make the most out of every situation. A good understanding of what we're investing in will take us very far. It will lead us to invest in companies that can withstand the test of time and work in our favor in the end. We cannot predict economic conditions or market performance. That's why we should be prepared for hard times as well as easy times.
I would say that I've been in business running Berkshire for 58 years, and I've never found economic forecasts of any use to the company. And all we have to do is keep running every business as well as we can, and we got to keep plenty of cash on hand so that people can keep making intelligent decisions rather than those forced upon them. And that's all we know how to do. And if I depended in my life on economic forecasts, I don't think we could make any money.
Things aren't as bad as they could have been, so we should stay the course. Economic forecasts won't do much to serve us in that regard. I like what Warren said about how buying into good businesses and keeping enough cash on the side allows him to make good decisions and not forced ones. The principles he employs are very simple and realistic, and yet so effective. So we can learn a lot from that, given that this comes with 54 years of experience. So we've heard Warren talk about the bank stocks and how he sold a bunch of them, but there's one that he didn't sell, and here he is talking about it.
Why did you keep Bank of America?
They invited, I invited myself in many years earlier, and they made a very decent deal for us, and I like Brian Moynihan enormously, and I just don't want to sell it. I did sell banks that we'd owned for 25 or 30 years, and if they asked me why I did it, I told them. But and I like the people. I just think the system isn't set up quite right in terms of connecting punishment to culprits on something that's it's incredibly important that your banking system run well in the country. It just isn't going to work unless you have a banking system that works, and you don't want them to create periodic crises unnecessarily.
Okay.
Warren values people and their management styles. You can tell that he trusts the chairman and CEO of Bank of America, which is why he stayed invested. This speaks volumes to how important it is to have the right person in charge, who can gain the investors' trust and deliver on their promises. I'm of the opinion that the biggest problem most of us have with the current financial conditions is that many of us haven't been at it long enough to see things work out in our favor. That's why I look up to people like Warren who've been there and have the results to back up their claims. I hope you've gained a bit of understanding from Warren today and that you'll be able to use what you learned to your advantage. Let me know in the comments below what you found to be the most interesting part of Warren's words. Also let me know what else you'd like to see me talk about in the future. If you found value in this video, please leave a like and share it with a friend. Subscribe to the channel if you haven't done so already, and click the notification bell so you can be the first to know when there's a new upload with more lessons to learn. Thanks for watching. Hope to see you on the next video, but until then, stay invested.